I have made over 1,000% returns using this option strategy, and in today's video, I am going to take you step by step through the ways that you can trade these options and make some money. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and today we are talking about LEAPS. We're going to go over LEAPS options and how we can profit potentially massively from using them in our investments. Now, I know sometimes it can be frustrating to wrap your head around all the details of option trading, but fear not, I am here to help and go step by step through every detail and make everything as easy to understand as possible, I hope. Now be sure to watch this video until the end, where I will share a bonus tip that is often overlooked when it comes to LEAPS. So if you are ready, then so am I, my friends. Smash that like button so we can begin, and let's get into it. So what are LEAPS? Well, this is an easy one. LEAPS are options that have an expiration date of 1 year or more. But Alex, why are they called LEAPS? Well, LEAPS stand for Long-Term Equity Anticipation Securities. Fancy term, but that just means that they're long-term options. Like I said, with an expiration date of 1 year or more. Now, the only difference between LEAPS and shorter-term options is just the expiration date. That's it. So, Alex, what do they call short-term options then? They call them options. I guess technically we should call them sheeps? That's not gonna work. Now, if we bring up the option chain to any company, let's say in this case, Apple, you can see that at the top here, we have the expiration dates that you can choose from. The earliest expiration date here would be 1 week away, and we call these weeklies. Or you can scroll out to 1 or 2 months out expiration date, and we call these, you guessed it, monthlies. Or you can scroll all the way to the end and you see expiration dates of 2023, 2024, and these are LEAPS. These are LEAPS because their expiration date is more than 1 year away, hence the definition. And of course, if you're watching this video in 2025, for example, your LEAP options would be 2026, 2027, so on and so forth. You get it. You're smart. I like you. Why buy LEAPS? Because they're awesome? Sorry, just a little excited for the video. Okay, so it's really important first to understand the benefits and risks of using LEAPS as an investing strategy, because of course every investor and trader is different and we all have different goals. So here is just a few things that can make LEAPS either enticing or something that you just want to stay away from. The first benefit of using LEAPS is the same benefit that you would have when using options in general, and that's that you'll leverage your returns and make a lot more profit than you would when just buying and holding stock, especially when you're buying at the money or out of the money options. For example, when buying and holding stock and that stock goes up by 50%, then you would have a return of 50%. But when buying options, if the stock rises by 50%, your returns are leveraged, so you can see returns of 100%, 300%, even 1,000%, which I have had quite a few times myself. The second benefit is that you can actually use LEAPS to substitute buying 100 shares of a company and mirror the exact returns that you would get when buying stock, but with much less money. So instead of buying 100 shares of a company, you will buy certain in-the-money LEAPS and pay a premium to control the same 100 shares, and that premium paid will cost you less money than if you were just buying 100 shares of that company outright. Now, this is very important, especially when you have a smaller account. You can use less money to control 100 shares of that company and use that extra money that you save to invest elsewhere and make even more profit, hopefully. Now, with greater reward comes, of course, greater risk. And well, what's the biggest risk of buying options? Well, you risk losing 100% of your premium and your option expires worthless. Congratulations, you have joined the ranks of Wall Street bets and alike. Proud? You proud of yourself? That means that if I buy an option and I pay $1,000 for that option, and my option doesn't reach my strike price by the expiration date, that option will expire worthless and I will lose the full $1,000 that I paid. So yes, buying and holding shares of your favorite company might be boring, but for the most part, it's a safer investment, let's just say, than buying options because of the time sensitivity that options have and the fact that you need the stock to get to a certain amount. Now here's where buying LEAPS come in, because buying LEAPS takes away some of that time sensitive risk, and buying in the money options takes away some of the risk of your option expiring worthless. But nonetheless, nothing is risk free in this world, I'm afraid. So as long as you understand that, you should be good to go. All right, let's go through some strategies. When you buy an option contract, you are paying a premium for that option. The option gives the buyer, that's you, the right to buy or sell 100 shares of the underlying company at the strike price on or before the expiration date. Now, when you buy a put, you are making a bet that the stock will go down to a certain amount and stay below the strike price by expiration. Now, when the expiration date comes, the option will either be in the money or out of the money. Now, what does that mean? Well, it's very simple to understand. When buying calls, in the money means the strike price is below the stock price at expiration. So let's say, for example, I have a strike price of $50 for my call, and at expiration, the stock price is at $55. Then that call option expired in the money. Now, when a call option expires in the money, then you, as the option buyer, have the right, if you want to purchase shares of the company for $50 per share as per the contract and agreement of your option. Now, this is a win for you because if you exercise your shares, you are buying something that is worth $55 for only $50. So automatically you have, in this case, a 10% profit. You can buy it for $50, sell it for $55, boom, keep the $5 difference. Now, if you buy a put, you want the stock price to go down below the strike price. So if you buy a put with a strike price of, let's say, $20 and the stock stays below $20, let's say it's at $15 by expiration, then your option expired in the money. This means that you have the right to sell shares at $20, and if the stock is trading at $15, well, that just means that you are now in the profit. Now, of course, you do not have to hold contracts until expiration. Look, when I was just learning about options as a beginner myself, I was always confused about this because the definitions of options always made it seem like waiting until expiration was part of the process. And even though in the traditional sense, yes, there are times where you do want to wait until expiration, it is not a must. You can always sell your contract further before expiration anytime. So if I buy an options contract today, expiring 2 years from now, and I decide, hey, I want to sell it tomorrow, well, I can do so. If I want to sell it next week, I can do that too. So don't be scared of buying leaps because their expiration date is so far away, years ahead. You don't have to wait until expiration. You can sell it anytime. Now that we understand the idea of buying options in the most simplistic form, I want to introduce two elements to the trade that will determine how risky your trade is and how much profit you can make. These two elements are the expiration date and whether you buy the options in the money or out of the money to begin with. See, you have the option, no pun intended, to buy options that expire next week if you want. That, as some of you may know, is extremely risky and you'll probably lose all your money. You can buy options with a few months to expiration. This is a bit better, but again, you are risking your entire trade on price action of just a few months. Now, what I suggest and what I do myself is buy leaps, options that have more than 1 year until expiration, because I want to take advantage of the macro trend of the market over a long period of time and let the overall upward trajectory of the stock market make me money. Now, the question is, do you buy in the money options or out of the money options when it comes to leaps? So what's the difference? Well, let's take a look at this. Let's say I want to buy leaps on Apple stock because I am very bullish on the company and I think the stock will trade higher 2 years from now. So I choose an expiration date of September 15th, 2023, which is just under 2 years away from the time of recording. Now, if I buy an option with a strike price that is beneath $161, then I am buying in the money options. So if I buy the $155 call or the $140 call, all of these are below the stock price and are considered in the money options. If I buy above the stock price, so any option above $161, then I am buying out of the money options. So the $170 call, the $180 call, the $200 call, all of these are out of the money options. Now this of course will depend on how much risk you are willing to take. If you want to be safe, then you definitely want to buy in the money options. In fact, one of the safest option strategies, in my opinion, is to buy in the money options with a delta of close to 1, which will mimic the same returns as buying 100 shares of the company without buying 100 shares of the company. Now I did a whole video on this strategy, so you can click here to watch that video. I highly recommend it. But back to Apple. So say I want to be safe and say I think that in 2 years' time, Apple will be trading at least where it is right now, if not a little bit higher. So I will buy the $150 calls. Now you can see the break-even price at expiration is $183. So this means that Apple needs to stay above $183 by September 2023 for you to profit from this trade. Now let's say I want to be a little bit more risky. I know I just did that. And I want to buy out of the money options. Whew, intense. So first you have to realize that the reason that this is risky is because if Apple does not reach the strike price by the time of expiration, you will lose your entire premium that you paid for this option. All gone, done. So just keep that, again, always at the back of your head when buying out of the money options. But let's say you look at Apple and you say, you know what? I think by September 2023, about 2 years away, Apple will be above $200. So I am going to buy the $180 calls that you can see that the $180 calls are out of the money and they have a break-even price of around $200. Now, by the way, why is this the break-even price? Well, the break-even price is just the strike price plus the premium paid. Now you can see that if you add this and if you add that, you get the break-even price. So if you are very bullish on Apple, you can make more money with out-of-the-money call options, but just, it comes with a lot more risk. One of the first Leap options trade that I made was buying out-of-the-money call options on Virgin Galactic back at the end of 2019. Here is a screenshot of that trade. Now, as you can see, I had an expiration date of January 2022, which at the time was about 2 years out, and I bought each contract for $2. Virgin had a huge run up at the start of 2020 and the contracts were now worth $19.45, which was a total return of 872%. And I think I closed the position shortly after at over 1,000% return. And a note on this is that I held this position for just a few months, certainly nowhere near the expiration date. So that goes to show you that you can make these huge returns with option contracts that have a far out expiration date and not having to hold all the way until expiration. So do yourselves a favor, stop buying short-term contracts. You know who you are. Yeah, you. No, still you. Alrighty, now for the bonus tip in today's video that I want to share with you. Now this is super important in options in general, but it's somewhat more important in leaps. This is something that is often overlooked, or at least not as much emphasis is put onto this particular tip that can leave you in, let's just say, not such a pleasant position. And that is liquidity. You need to make sure that the leaps that you buy have liquidity. The options have to have enough trading activity on it so that you can sell your positions when the time comes. The last thing that you want is to be stuck with some options that nobody's gonna wanna buy when you go and try to sell them. You'd be like the hot dog person at the baseball games. Hot dog, hot dog. So when setting up the trade, there are a few things that you need to look for before jumping in. The first thing is the bid-ask spread. This is going to be a sign of whether the option has some good activity on it or not. If you see a bid-ask spread that is very wide, as in the bid price is far away from the ask price, then it might be hard to fill your trade. And even if you do fill the trade when you buy the option, you automatically will be at a loss and it'll be more of an uphill battle than you would want. The second thing that you want to check is the volume and open interest in a particular option. See, these two metrics will determine how much interest there is in that option, or in other words, how much liquidity it has. Volume measures how many contracts have been traded in that particular trading day, just like you would see volume on a particular stock when you want to buy and sell. Now, the more volume there is, the better, obviously. But you want to be checking in on that more than just that one particular day to see if the volume is consistent over time. The open interest refers to how many contracts are open at the moment. So if you buy 10 call options, for example, of Apple, then those 10 contracts would be added to the open interest as being open. Now, when you close the position, those 10 contracts will be removed from the open interest because, well, they're not open anymore. And this is why you're subscribed to Pandrea Finance, in case you're wondering, for great tips like this. So let's jump into seeing this in action. We're taking a look at Apple again for our example. We're gonna hit trade and trade options. And just so you can see what good liquidity means, we're gonna click on December 17th as the expiration date and go ahead and click on the $165 call. Now you can see the bid-ask spread is between 261 and 285, so relatively close together. Click on that and you see a bunch of information pop up. And with this information, you're gonna see volume and open interest. Now, Apple has massive volume and open interest, 24,000 for the volume. That means 24,000 contracts in the course of this trading day have been traded, and open interest 38,000 contracts have been opened but not closed yet. Now, if we click out of this and go back to an expiration date of, let's say Let's go all the way out to June 16th, 2023. Again, let's say we think Apple will get to around 200, so we'll buy the 185 calls. Now you can see here the bid-ask spread is still relatively close. It's less than $1 apart. We're going to click on it and you can see the volume is 3. Only 3 contracts have been traded in this particular trading day. And the open interest is over 1,000. That means 1,000 contracts are open that can potentially be bought or sold. So this is good. You know that if you buy the $185 calls, there would be some interest for you to not only just buy them, but also down the road sell them with no problem. Now, if we head back and instead of Apple, let's take a look at the Revolve Group. Now, this is a clothing company that I invested in shortly after they went public, and then of course sold it all right before it took off. Cool. So we're gonna hit trade and trade options on Revolve and go out to, let's say, January 2023. So I decide that I wanna buy some LEAPS on Revolve, and I think that the price will reach $100, let's say. So let's go up to where the break-even price is about 100, the $90 call, and I click that and you see, $9.90 to $12, bid-ask spread, not the best. And I click on it and I see volume of 0 and an open interest of 3. So not the best, and chances are if you buy this contract and for some reason get filled, not only because the bid-ask spread is a little bit higher, you'll already be in the negative with your contract, but then it'll be very hard to sell because the liquidity is just not there. There is no interest in this and you just might be stuck with it. So always remember to check all these details before jumping into a trade for, well, your own benefit. Now, there are a lot more areas of LEAPS that we will explore in the coming videos, such as selling LEAPS instead of buying them. This is a strategy, believe it or not, that Warren Buffett himself uses. Also, we'll go into buying LEAPS and selling short-term covered calls against your LEAP positions. We are going to learn to do all of that, all coming up on this channel. So subscribe if you haven't already, and hit that bell notification little thingy because you never want to miss a video. You can check out my other videos on options by clicking here and here. And as always, thanks for watching. Pandrea, out.